Hey everybody, and happy Friday. This is John Rothe. This is my big picture weekly market update. This is for the week of September 9th, 2022. So to start off with, I want to talk a little bit about the Fed. So Fed chairman, the chairman of the Federal Reserve, Jerome Powell, came out yesterday and had some fairly aggressive remarks regarding inflation, the economy, and what their stance is on future interest rate hikes. This has changed what I think people and what the market is expecting in terms of rate hikes going down. So I'm going into the future. So I'm going to talk about that in just a second. The big thing is inflation. Inflation seems to be lingering around a little bit more than I think the Fed had hoped for. This is the general inflation rate that the Fed really focuses on. And you can see here, it's really been lingering. It hasn't come down the way I think the Fed had hoped it would, especially after all these rate hikes that we've had so far. And here, this is if you take out food and energy. So you can see the impact that higher food prices and higher energy prices are having on inflation. But really, I think they're really focused on this top area here because what really impacts individuals is food and energy costs. And that's what they really want to start reducing. This dotted line here, this is a 2% line. This represents the Fed's historical target for inflation. And this is what they're trying to get the inflation rate down to. So you can see they have a bit of work still ahead of themselves. I think what really they're worried about is having this dramatic spike in inflation. Inflation can get ugly really quickly. And the Fed, I think, is worried that this hasn't come down the way they had hoped it would. And this is a big concern, that having some type of spike in the near future in terms of inflation. I think this chart does a great job explaining the whole situation and where we are right now. This orange line, this is the GDP, and it really represents the demand in the economy. This pink line is our pre-COVID line, really for our level of capacity that we could have in terms of production and services within the economy. And every time we get above this pink line, we start to have inflation. Now, post-COVID, because so many people left the workforce, a lot of people retired early. Some people just decided that they were going to stay home, maybe go back to school. But for some reason, a lot of people left the workforce. And this is fairly evident. Obviously, if you go anywhere, if you go to a restaurant, staff is usually, the places are understaffed. Supermarket, all sorts of stores and places are understaffed right now. And this is also having an impact on the supply chain because obviously people are in that area as well are understaffed. So this is the area where it's really estimated to be really our capacity level. So, and this is where we are in terms of demand. So the Fed really wants us to get to this level. And as you can see here, they have a lot of work ahead of themselves. So until we equalize out this capacity level and the demand level, I think the Fed is going to start really acting aggressively, especially as we go into the end of the year here. In terms of rate hike odds, this is what the market has been expecting. You can see here a week ago, there was really a 57% chance that the Fed was going to raise 0.75 of a percentage point at the next meeting on September 21st. After yesterday, that has jumped to 86%. So the market is really starting to expect a higher level. Before, people were hoping for a 0.5 point rate increase, really a 0.50% rate increase. And now we're looking at something more aggressive. And this is, I think, becoming factored into the market. Once that does, it kind of gives an open door for the Fed to act like that because obviously it's not going to surprise the market in any way. So this is going to get priced into the market over the next couple of weeks. And when we see that Fed meeting come out the 21st, I think that the odds are very high that we're going to have that 0.75% rate hike. This has had an impact in some areas of the market. You can see here the mortgage rates are starting to rise dramatically again. And as the rates rise, I wouldn't be surprised to see these mortgage rates start to increase. And what they're really trying to do, I think, is reduce some of that liquidity people have in their home equity. A lot of homeowners, especially when we had this super low interest rate, they refinanced, they took some equity out of their house. And this has added a ton of new equity into the economy, which people are obviously spending that money or paying bills down. But a lot of that money has come back and gone right into the into the economy. And since we have this this mixed up relationship right here in terms of capacity and utilization, it's causing inflation. So they're trying to strip out this equity that's in there, but I think a lot of people have already taken that equity out there. So it is going to slow the housing market, but I'm not sure if it's going to have quite the impact that the Fed is hoping it's going to have. Looking at the S&P 500, there's a lot of lines I drew here on the chart, so I'm going to walk you through these. This orange line here, this is the 50-day moving average. This red downtrend line has been acting a bit of as a resistance, almost like a brick wall. And you can see, especially here, this last point, this was a big inflection point for the market. And as we hit that 50-day moving average, which happened to coincide with our downtrend, the market got rejected and started to turn back down. This is our upward trend since that summer low, and you can see it's been acting as a level of support. Happens to also coincide with our cloud model. It's also acting as a level of support. So what typically happens with these triangle patterns is the market bounces between these two levels for a while, and it almost like it builds up strength, almost like it's coiling up like a snake. And once we break through to the upside or downside, the market all of a sudden jumps all on board, and we typically have a very strong move to the upside or the downside. Right now, we have a fairly oversold market, so that's supporting a bit of a bounce here in the market, but we'll have to see how that plays out. But it looks like the market might rally a little bit over the next couple of days to possibly weeks. But until we really resolve this issue of this triangle pattern, I think the market's going to be a little bit range bound in between these two areas. So the big question is, what are the odds of it breaking upward, or the odds of it breaking downward? Well, for that, I like to look at these weekly charts, and this gives us a little bit of a longer time frame. And you can see here's our triangle pattern, but what's different is the cloud model here on the weekly chart has been acting as a level of resistance. And you can see we bounced right back down from that level here. From our oversold conditions, the market, and overbought conditions, the market was a bit overbought here at this level and has started to retreat back down. So on a weekly basis, it's favoring a decline, and momentum is starting to decline as well on that weekly basis. So in terms of where does the weight of the evidence lie, it seems to favor that we would have some type of decline in the market. And potentially, a lot of people have been talking about this pre-COVID high level as a potential target. So we might retest these levels or trade a little bit below it and test out this COVID high until the market really, I think, starts to rise again. So for it to break upward, I think there's a lot of roadblocks here, and we'd have to have some type of really big news, possibly on the inflation front. That's maybe inflation is starting to really dramatically drop, and that the Fed doesn't need to be as aggressive as it's being right now. But that doesn't look like that's the case as of now. In terms of areas to keep an eye on, oil has been starting to, I think, hit a big key support level here, and it's been bouncing around this level here. And I wouldn't be surprised to see oil prices start to rise again. And unfortunately, that means higher prices at the gas pump. So we'll have to keep an eye on this level of support here. It seems like the market really got down to this level very quickly and starting to turn right back around. If we look here, if you're not familiar with this, is a chart showing DeMark Indicators. And what DeMark Indicators represent is really exhaustion within the trend. So if we have a downward trend, it's really showing that the downward trend has exhausted itself. And when we see these 9s or 13s, that's basically a pivot point. It can act as a timely indicator. And we can see here on the oil prices, we've just had a buy signal on these DeMark Indicators, and the market's starting to the oil market starting to rise at this level. And it can provide very timely signals when we hit these inflection points, when we hit these exhaustion points within the trend. So we want to keep, again, an eye on the oil market, because since it really had that timely buy signal right as we hit this major support level. Looking at the market strength overall, you can see we have a lot of mixed signals here, but the big area to focus on is this 200-day moving average. And you can see a lot of the broad market is just trading below that. And that 200-day moving average for a lot of people represents whether we're in a bull market or a bear market. And for investors to view the current market as resuming a longward upward trend, we want to see more and more of these areas start to break above the 200-day moving average. Most recently, during that summer rally, a lot of these areas hit that 200-day moving average and got rejected and turned around and started going back down again. So you can see it acts as a bit of a resistance level for the market. So again, for us to be confident that, hey, this market is starting to rise in a longer term fashion, we want to see more and more of these areas start to break above the 200-day moving average. And right now, we're just not seeing that. In terms of bond strength and what's been going on in the bond market, these are our bond ETFs. And if you remember, as price declines, interest rates rise. They have that inverse relationship. And we can see here, we have a lot of negative sell signals here. And again, below that 200-day moving average. So bond prices seem like they're still falling. Nobody seems to really want to hold on bonds here, and that is having obviously the impact on higher interest rates as well. So if you have bonds in your portfolio, like a 60-40 bond portfolio, for example, you can still expect further declines, I think, on the bond side as well. So looking again, just to summarize everything, I think the big thing for the market is going to be resolving this pattern right now for over the next couple of weeks. And it doesn't necessarily mean we have to wait to November to break through. We could break down or break above this in the next day or two, or next week, or next month. It doesn't dictate how much time is on there. But what really is important are these rising trends and this falling trend line, and which way we break out of. Because again, this almost acts like a coil. And once we break through it, typically you have everybody jump on board in one way or the other, and the market tends to aggressively react in that direction. So that's the big area we want to keep an eye on. For now, it looks like we're just kind of stuck in this trading pattern, as most likely investors are really just holding on right now, not willing to commit either way until we get more and more of this inflation data and see what the Fed says at the Fed meeting later this month. So that's it for this week. If you have any questions, please feel free to reach out to me at john.rothe@riverbendinvestments.com. I'm also on Twitter at John Rothe, where I post more daily charts and things of that nature, a little bit more detailed analysis. I also restarted my research blog at www.johnrothe.com, where I put things that aren't really related to our client portfolios, but just kind of more big picture items, big research items that I'm just kind of looking at any particular time. So that's it for this week. Hope everybody has had a great summer and is looking forward to fall. And again, if you need anything or have any questions, please do not hesitate to reach out to me. Thanks so much. Bye-bye for now.